So I'm just going to go through some of the announcements. Jim, I'm not Jim Pfeiffer, as that says, but I am Steve Sue, and one of the founders. So I just wanted to go through a few announcements here before we introduce our monthly meeting guest and speaker. So we're really excited about our meetup in the left field. It's our first in-person meeting that we're going to be having for left field investors. We're going to have speakers and a bunch of networking going on. It'll start off for the infielders. If you're an infielder, you're invited to a dinner on Thursday night, October 20th. And then we'll continue on with the all-day Friday meeting on October 21st. So more details about the venue and the hotels will be forthcoming. You should have already received information about registering. And if you go to the website, there's a pop-up that that shows how you can register. And the keynote speaker is Paul Moore from Wellings Capital. Tomorrow, we're going to have another mountain visit for the infielders. It's going to be hosted by Ryan, and that's going to be 2 p.m. Eastern time. And this Friday, which is, let's see, August 26th, we are going to have a lunch and learn on mineral rights with Troy Eckert from Eckert Enterprises. He's a very good speaker, very dynamic. He'll definitely keep your attention and knows the oil and gas space extremely well. And the next crypto bullpen will be not on Labor Day, September 5th, but it will be on September 6th, that Tuesday at 7 p.m. Eastern time. Hosted by Pat and Eric. And just an FYI, we have several deals that are still out there where we have aggregated money and gotten better terms for our investors, our members, I should say. Group RMC, which does office space investing, they have lowered their minimums for us. Spartan has their fund, and Mag Industrial Fund is also out there as well. So they are still open, so you can take advantage of the better returns. And then I believe Rise 48 might have another deal coming up with better terms for left field investors as well. And as usual, after the meeting, which should end or hopefully around 8 o'clock or maybe before, we'll have some networking, virtual networking on the wonder.me platform. I will put the link in the chat. So we're very excited to have Evan Polaski. Did I pronounce that correctly, Evan? Okay. Yes. He is the investor relations manager at Ashcroft Capital. Prior to joining Ashcroft, Evan spent 9 years investing his own capital in real estate projects. Before that, he took on various roles for a nationwide grocery anchored shopping center, including investor relations and capital raising for both high net worth individuals and institutional investors, capital markets securing new acquisition financing, refinances, and credit line facilities. In total, Evan has been involved in raising nearly $1 billion in capital on both the debt and equity side of real estate. So today he is going to be talking about the pros and cons of single asset deals versus funds. I'll let you have the platform there. Go ahead, Evan.
Thank you. I was about to call you Jim because I'm looking at the name. Thank you, Steve. I'm excited to be here, and as someone who's only about 90 minutes south of Jim, and really got apparently Steve as well, based in Cincinnati, Ohio, and became familiar with left field primarily through Bigger Pockets. As I joined Ashcroft, I'd always heard of Bigger Pockets, but with Ashcroft became much more active in that forum, and have found a lot of personal value from that group. And obviously Jim is a big contributor that he and I are chiming in on similar topics quite frequently. So definitely excited to talk to many of the group. And as Steve had mentioned, today I was planning on talking about single assets and funds, and kind of the pros and cons in each, and getting into a little bit of the weeds with each, and how I, my personal view on them. So I'll pull up my screen share here and get that going. So as why is this? Of course, now my computer's thinking. There we go. So as I titled this, just passive investing through a fund versus single asset offerings. Just from familiar with a few of those groups that Steve had just mentioned, I'm 99% sure Rise 48 still does specific deals. Spartan has moved to a fund. RMC and MAG I'm not as familiar with, but as you guys are probably seeing, I feel like the fund model has become more prevalent in the syndication space over the last particularly 12 months. It's always been around if you're relatively new to the syndication space, as Jim noted. In fact, I get here a little bit about me, but my professional experience started in 2007, right out of college, with an operator that was raising was technically their third commingled fund. It was with institutional investors, where Fund 1 and Fund 2 were with high net worth individuals. And that group was founded in 92. So they did single asset offerings until early 2000s and moved to the fund model. So every once in a while, I'll hear somebody that, from my conversations professionally that, that has really, they feel like the fund model is new because they just haven't been in the space that long. But it hasn't, is the point. As Steve had mentioned, started my career in 2007 with a grocery anchored shopping center company. Raised money from 2007 right into the heat of 2009 when I was let go. Because imagine that, the capital market shut down through the financial crisis. And went into some retail leasing for a year and a half with a local developer here in Cincinnati. Did exactly half of a deal. I got one really well teed up, and they closed it once I decided to go back to a more stable employment base. But have some experience in the accounting world, the investor relations world, equity and debt markets, leasing, and then from a personal level, bought my first investment property in 2010. So that's a single family rental out of foreclosure here in Cincinnati, doing the Burr model before Burr was even called Burr. So copper was stripped out, AC unit was stolen, needed relatively major renovations, but did that for a while. I still own 2 of those, but had built a portfolio up to 9 assets before really starting to move more into the passive world, as many of you probably understand, as I know Jim talks about on Bigger Pockets. I'm assuming Steve says similar things. Sometimes your time becomes more valuable than the overall return. And being able to hand that off and just place capital, it fits the lifestyle and the time commitment better for many, many investors. I made my first truly passive investment outside of just owning some REIT stocks through 401ks and other equity markets in 2020. So it took me a while to really get familiar and comfortable with that space as an LP. And honestly, before even joining Ashcroft, was considering starting to move in the direction of looking to raise my own capital and become a GP on my own deals. And admittedly love the role that I'm in now. It's less stress and love what I do. So as noted, today's topic is really just kind of a comparison of the single asset offerings that many of you are very familiar with, and the fund offerings that many of you are probably also familiar with, and really how I view the two. So starting with the single assets, because they're easy, they're what most people are familiar with, particularly when they're first getting started in syndications. And as I mentioned, up through the last, in my experience, funds have always been around, but for the more retail investor side, the approachable side, like myself, making those $50,000, $25,000, even maybe up to $100,000 minimums, funds seem to have taken on more traction over the last year and a half. But with the single assets, just kind of hitting on some highlights. You've got the pros. Of course, there's the known exposure. You can look at that deal, where your money is going because it's going into that deal. You have more investment control accordingly. So you know what state it is. You can pass on the deals you don't like. You can go into the deals that you do like. They're easier to underwrite. You have one asset, it's known. You can look at those assumptions, do some basic Google research. Obviously, if you have access to kind of paywall type research, CoStar, Yardi matrix type stuff, you can really drill down into that asset on your own. And of course, the biggest piece for many investors is you're more likely to hit a home run because it's just that one deal. If that one deal performs very well, you're looking like a rock star. Now, with all the pros in anything, there are cons. So, one of the biggest ones as an individual investor myself, thankfully accredited, but I'm not, somebody who just has millions of dollars to throw around. It's more expensive to build that diversification. The easiest example, obviously, is if you have a $50,000 minimum and you're trying to build an 8-asset portfolio, it's going to cost you $400,000 to get an 8-asset portfolio at $50,000 per pop. With all the upside available, the higher likelihood to hit a home run, the downside is also there. That deal collapses and all of that money's lost. There's nothing else in there. And then a slightly more nuanced one, and when I'm talking professionally to potential investors at Ashcroft, I always caveat with, I don't use this as an investment decision, but it does help. And it's the lower formation costs, and specific to the LPs, getting more K1s, or sorry, higher formation costs with the single assets, because you've got to draft, the GP has to draft a new PPM for every single deal. There's blue sky filings, there's just more costs, and it's isolated to that one deal. And then you got to spend all that money again for the next offering. And that starts to add up when you're talking deal after deal after deal. And of course, from the LP perspective, you get a single K1 per deal. So that flips us over to the fund model, if my computer will work. There we go. So what's a fund look like? Basically trade out a lot of those things. So you have the diversification. Typically, that's the biggest single reason that people like funds. They make a single investment and it gets spread into multiple deals in most funds. So obviously, when I'm talking funds, I'm talking about a diversified fund. There are different styles of funds, i.e., in a truly technical sense, for the most part, a fund would be defined as any offering that is launched before the deal is found. So there can be single asset funds. Grant Cardone does a lot of those because he will start raising money from his pool before he ever finds a deal. And that is technically a fund because of that. But the more common idea is this diversified fund, which is what I'm hitting on. The same downside of the single asset is with most funds. So I do put likely, because every fund could be different, but every fund I've ever invested in and have ever worked on, it's a single K1 for that fund, because you're an LP in one entity, and that entity then goes and buys the assets. So it does make a slightly easier tax filing, considering you're getting multiple assets, but with a single K1. And then I call it the lower buy-in rate. Again, it's going to be deal by deal, because some funds, as Steve just potentially alluded to, might have a $500,000 buy-in. So groups like Left Field are great because you can, compile your assets together or your investments together to get into those, even if you're coming in a lower amount. But in general, assuming the minimum is the same from a single asset and a fund, you can get into multiple assets for a much lower buy-in. Again, same idea. If it's a $50,000 minimum in the fund and there's 8 assets, well, I got 8 exposure to 8 assets with $50,000 instead of using that same example in a single asset where it's $400,000. Now, the biggest cons that I've heard in my conversations and working with investors is you can't select the deal. In a diversified fund, you're either in the fund or you're out of the fund. So one thing I've heard in the past is, I don't like to invest in Florida. This specific investor had a hard no on Florida. Well, specific to Ashcroft's fund, we invest in Florida. And so if you're going to be in the fund, you're going to have some Florida exposure. So if that's a hard no, then you can't, that doesn't make sense. Of course, along those same lines, you're entering a blind pool many times. So depending on how the fund is structured, many times they will raise all the capitals in terms of commitment and then start buying once that fundraise is over. Now, again, each deal is going to be unique. Some funds will raise and acquire all at the same time. But even in that scenario, if you invest early, you're getting into a semi-blind pool of assets. So you really have you need a lot more trust in that sponsor. And back to that point of the raise and then call in that structure in particular, which is some of the funds that I'm personally invested in, it creates idle capital. I have a $50,000 commitment out there that hasn't been called yet. And so I kind of have to sit on that $50,000 liquid, because while they anticipate calling about 20% next month, they could call 40%. And so I don't know, they could call 100%. So I don't know what that's going to look like. So I kind of have to sit on that money and have it available for any period of time. Again, each fund is structured differently. So there are funds that don't have that, commit and then call structure, which mitigates this idle capital. But I would call the commit and call structure is probably slightly more common in many instances. So diving into the structures, a lot of times when I'm talking to investors, both personally and professionally, there just seems to be a misconception as to like what a fund is, what it isn't, and how it may or may not differ from what they're used to in the single asset. So very commonly, both are LP structures and your tax form's a K1. Simple as that. Very commonly, again, of course, each deal is going to be unique. You've got your general partner. That's pretty much a given. And they're compensated through both a combination of fees and carried interest. Again, there's going to be deals that are full carried interest. There are going to be deals that might be almost exclusively fees. But generally speaking, that's going to be their compensation structure. Generally, you're going to be dealing with people who have a track record in that business plan. And so again, this is something I call out later of questions to ask or better understand, but making sure that particularly if they've moved to the fund model, since you are no longer able to see the deal and what that specific business plan that they are laying out for that deal is, if you're going in blind, just understanding that the deal, the fund's business plan ties to their track record. And most of the time it is. They've built their track record on single deals and they're moving to a fund for better reasons. And then again, just from an overall tax perspective, I always have to caveat this with each deal could be unique. A sponsor could change how things are treated between a single asset and a fund, but most of the time in my experience, it's treated the same. So things like pass-through depreciation through bonus depreciation, obviously the K1 tax form, how they treat distributions in terms of, from a tax perspective, is it return on, return of, is it classified as a distribution? Most sponsors keep that consistent because, again, they've built a track record one way. And one of the worst things you can do in any investment is throw out surprises to your investors. So I found in my experience that a lot of the ins and outs of the structure do remain very comparable from track record and prior experiences and one-off deals if that sponsor has moved to a fund model. But that does leave differences. So in a single asset, most commonly, almost exclusively in my experience, actually exclusively in my personal experience, you're funding everything up front. So you put your $50,000 in, they call that money today, it's in there waiting for that deal to close. Contrast that with, as I mentioned, with the fund, where many times it's the commit and then call, so potentially over time. So you create that idle capital possibility in that scenario. Both charge fees, as noted. Of course, always look through each raise document. I didn't want to get into this because every sponsor has different fees, but a common fee in both is that they have an asset management fee, AMF. The biggest difference is in many of my one-off deals, that AMF, that asset management fee, is tied to their to the revenue that's kicked off by the asset. Maybe it's 2%, 1.5% per year of revenue, versus a fund model where it's much more common to have it tied to the equity raised. And so again, just a nuance to understand, and particularly if you're comparing somebody's track record that has moved to a fund, are their fees consistent in how they're charged? If they're not, how do they net out back and forth? A big one in terms of risk mitigation with the single asset, again, you're isolated to that asset. There's no other income coming in from other assets like in a fund model. So technically the risk of a supplemental capital call would be higher. And again, I'm specifically calling out that what if something bad happens, the sponsor needs to raise an extra $5 million, and how is that handled? Because it's a single asset and presumably in that scenario, the asset isn't creating enough income to, to fund that $5 million shortfall, whatever's causing that, then the sponsor may have to come back to the investors and make that call. Compare that to a fund where you have a commingled pool. So if what's occurring that's causing that $5 million shortfall is isolated to a single asset, but you have 8 in the fund, well, now you can start moving money around within the fund to fund that. So I'm not saying it's impossible for supplemental capital call to happen in a fund, but it's a little bit less likely because you presumably have income coming in from other sources. And then one other thing that I've seen some groups really be able to capitalize on well is the ability to take out fund level debt. Obviously, there's no fund. There's a specific asset in the single asset. But when you get into the fund and the commingled fund, there's various facilities that you can use as an operator to help finance the overall deal, whether that be acquisition vehicles against capital calls, so capital call facilities, capital commitment facilities, which again, one of the funds that I'm in, they are using, hence the reason I don't have any capital calls yet, even though they're starting to make acquisitions. Another group that I'm friends with, a former employee of that group, they were taking out fund level debt, to finance some of the acquisition. So lower property level debt combined with fund level debt. And they were able to, because the fund level debt was floating rate debt, they were able to create some, significant 7-figure value out of some of the financial instruments, either the capital, sorry, I'm losing my terminology now, the interest rate cap that they bought for that floating rate fund level debt lived beyond the actual assets in the fund, and how the capital markets moved. They had sold off the assets or all their floating rate debt assets, paid off the facility, and yet the interest rate cap still had term left on it that they could sell to another group. And in, I consider this like gamblers. They only, whenever you talk to a gambler, they only tell you about the days that they're up big time. This particular group, they bought this cap, to mitigate the risk first and foremost. That was the only reason. But the capital markets happened to move to the tune of, he said this was about a $1.2 million profit that they were able to sell the remaining term of that interest rate cap for. And that was primarily because it was an interest rate cap on a fund level debt. The fund entity still lived even beyond the assets, and so they could sell off that piece. But from a bigger perspective, there are abilities to create additional efficiencies through that fund model through various financing structures that generally are not there on single assets. So kind of to give you some kind of talking points or things to think about if you are considering a fund model, particularly if you're used to the single asset, or vice versa in reality. The first one, as I had alluded to, are there any hard no's? So I mentioned, or I utilized a story of an investor who told me they do not invest in Florida. And from a professional standpoint, that took Ashcroft's offering off the table for them because they had invested in Ashcroft's Texas deals, but not their Florida deals. So if there's any hard no's and the investment thesis of that sponsor might include those, then a fund is probably not going to be for you. Of course, if there's not, or if they're minimal, then maybe the efficiencies help counterbalance that. The biggest one with a fund, and why you don't see most sponsors jump right into a fund model, especially newer groups, do you trust the sponsor, or are you only trusting the deal? Most new syndicators, most new investment houses start with single deals, not because they necessarily want to, and they very well might want to, but because they haven't established themselves. And when you're a new syndicator, you're using the deal as much as your own background to sell the deal. Once you have that background established as an operating company, as a sponsor, then you can start to move to that fund model with a little more ease because you have a track record in that business plan and it's no longer just about the deal per se. One question I always ask when I'm considering specifically a fund, although technically this is true for the single asset offerings too, are they in the same business plan, same business model that their track record is indicating? When I'm getting into a new deal, especially with a new sponsor, that track record is just as important to me as the current offering. What have you been able to do? What scenarios have you lived through? Were you around in the financial crisis? How'd you get through COVID? You just got to trust them. You got to build that trust. And so understanding their track record relative to what they're offering today is a really big one for me. The easiest case is if you're a multifamily syndicator and you're moving into self-storage, you're a new syndicator to me. I don't care if you did great in multifamily. You don't necessarily know anything about about self-storage. And so it's going to be a harder sale to bring me on as an investor until you've done some self-storage deals. And then, of course, do I understand all the terms and risks of this offering? That is, you need to understand it no matter what you're getting into. That's something I think left field is great for, particularly for newer investors in their educational content and being a sounding board from their longer term members. Obviously, not all of you I've known. Some names look a little familiar, but being able to use that resource. I got that exposure professionally with the first group I ever worked for, learning PPMs, asking my boss question after question after question about how does this work and how does that work and what happens if, and all those kind of questions. Most people aren't in my scenario or my situation. So having that kind of mentor group to reach out to. Particularly while sponsors can bury things in single asset deals, as we all know, PPMs or the full subscription documents can be well over 100 pages. I've heard some people tell me they've seen documents as many as 400 pages. But the point being, you really need to understand what those terms are. And I think there is a little ability to hide stuff into fund offerings, or sponsors in theory could, because it is a blind pool. So there's different ways they can finagle that language. So I put this in there. Hopefully you guys care, because most people, when they bring me in to talk, they kind of want to know where I am. Admittedly, as I note, I'm agnostic. I look at single asset deals. I like them. I'm still investing in them. I like funds. I'm in those and I like those. If you look at my passive portfolio of investments that I still hold, about 40% of my capital is tied up in single assets, 60% in fund assets. And, while I do happen to see more funds out there that I'm leaning towards, it's not because of the fund model per se. A lot of it, as my second bullet point says, it's really sponsor dependent. I have to like that sponsor. They have to have a good track record. They have to have experience through the financial crisis, if not sooner, ideally into, in an ideal world, I'm picking groups that are run by 65-year-olds who started their career in the savings and loan crisis in the early 90s. Is that right? That'd be 30. Yeah, about 65. So I just like that, particularly in the market that we're going into. A financial crisis is a must. A .com bust / savings and loan crisis in the early 2000s, early 90s is a very, very nice to have and preferred. And then I have to like them. They have to be responsive. Many of the groups, I know them personally. Of course, and that's on top of everything else. The business plan, the asset class. You guys were talking a lot about crypto, something there. I've invested crypto in November and watched that go down 40%. Thankfully, it wasn't a ton of money. And then with the funds in particular, I don't really have any hard no's. I'll invest in California. I'll invest in New York. I'll invest in industrial. but my kind of things are, I like specialists. I like people that are, focused on one asset class and one style of operations. I don't want my value add multifamily group doing new development, and I don't want my, self-storage people start doing mobile home parks. If I want that exposure, I'm going to pick somebody that is a specialist in that piece. And with that, that's really all I have. So I will open it up to everybody's questions.
Yeah, thanks, Evan, for that presentation. That was awesome. So we'll open up the floor. If you guys have a question, either raise your hand or just go ahead and start speaking, or just put it in the chat, and I can just read it off to Evan.
And I do say I may have hit it right as she asked it, slightly unintentionally because I wasn't watching the comments. Kelly asked, "What are your hard no's?" So as noted, I wouldn't say I necessarily have any specific ones. I'm not a huge fan of anything that is easily repeatable. And I say that working for a company that invests in suburban apartment complexes, but they do value add. So when I'm thinking about that, I'm thinking of like suburban office development. Office kind of scares me. It seems to be doing well, even with the work from home in specific markets. Crypto is probably my biggest hard no, which isn't even really what I was talking about. But I think that you can still do crypto funds clearly. And, I bought my first $20,000 of Bitcoin when it's $55,000 a coin. And I don't even watch my Robinhood account where I hold that anymore to see what it's at, but I know it's a lot lower than that. But I'm also buy and hold. So that's money that I will not touch for a decade plus. And, that's my biggest hard no.
Anybody else have a question? Looks like something came up here. Let's see. Pat says, "I'm assuming funds use the 506 exemptions like their single asset counterparts. How are the compliance, bookkeeping, admin expense ratios between the two models?"
So first part, 506 exemptions, yes, you're still gonna have 506B, 506C funds. Generally speaking, just like your single assets, I mean, the same rules apply. Your 506B offerings tend to be harder to find because you have to have a network. You have to have an existing relationship. 506C can run advertisements all day long on Instagram and Facebook and Google AdWords and everything else. So generally you just tend to hear of those a little bit more. But it is the same overall rules. They're both private offerings, Reg D offerings through the SEC, with those exceptions. From a compliance, bookkeeping, admin, expense ratios, there's slightly more bookkeeping. And again, this is going to be very nuanced depending on how integrated the company is. So I'm going to speak from both my prior experience with the retail operator, where they were a full-on owner operator. There were 250 employees. Management team was built into the overall company. Ashcroft is the same way. We're vertically integrated, so we have in-house accountants. So I'd say the expense ratio for bookkeeping in particular, general admin, is slightly higher because you do have to consolidate, a bunch of individual assets into a fund, but it's generally not that much more work. But if you're paying an outside group to do all that, I'm assuming it can add up relatively quickly. Compliance, again, about the same. I'd say, if anything, you're probably slightly lower on compliance, and I am guessing here, because you have a single offering. So you have more investors commonly, assuming a similar investment amount in a fund, because it's going to be a bigger offering relative to the one-off assets. But if you look at trying to make 8 assets and all the compliance of each of those 8 individual offerings versus one bigger pool, this is actually more efficient on that side. And then from how that's really going to affect the overall returns, a typical offering is going to cost between $15,000 and $25,000. So if you're talking about a $2 million raise, that can be somewhat significant. If you're talking about a 50, 100, $150 million raise, you're not talking a huge dollar amount in terms of actual expense ratios relative to the equity raise and size of the portfolio. But it is, like anything, those pennies add up to dollars, those dollars add up to hundreds, et cetera. So that's my off the cuff logical thought, because I haven't actually looked at, how many billable hours might be applied to one versus the other, but kind of educated guess there. From one fund of theirs to another fund they manage and doing recaps. So what does sponsor have to gain from implementing the strategy versus refi and return the capital? So Patrick, if you have more questions about that, feel free to throw them in there, but I'm going to jump into Sameep's questions. My thoughts on GPs selling assets from one fund of theirs to another fund, it's going to be very case by case. Full disclosure, Ashcroft did a recap of 9 assets in May. If you've seen the press release, we partnered with Goldman Sachs. It's 3 partners led by Goldman Sachs and Blackstone. They're the same group. One's just their private equity group, and I can't remember which. If we had only taken it to them and just accepted their, so we effectively sold the assets from the retail LPs that we originally raised from, and we sold them to Blackstone, partnership with Blackstone and Goldman, where Ashcroft has been retained as the general partner of that new investment, of that new offering. I bring that up because we marketed that group to over 40 different groups. So I would call that a pretty well marketed, offering, where we got a dozen offers and negotiated the best one. And actually Goldman brought it, and they kind of brought in Blackstone, who had offered $50 million less on that offering. But once Goldman was on at a price, then they were good. And we beat projections across the board on those assets for our existing LPs that were bought out. So in my opinion, and this is truly my opinion, I'm still okay with that because it was broadly marketed. From a professional standpoint, it stunk because there's a lot of skepticism that comes from that, and therefore a lot of questions that were brought to me from those investors, like how widely was this marketed? How much did you negotiate, et cetera? Because we were retained at the GP. Now, I've also heard the horror stories where it's just a straight, hey, our 5 years is up, or whatever the reason, we're recapping it, we're putting it into this deal, and it's not marketed. And then who's getting the better side of that deal? Is it the sellers or the buyers? Because somebody's taking a haircut if it's not going to be broadly marketed and you can really back into that number. So in those scenarios, it doesn't make as much sense. But from there, it comes down to what the company offered. So, versus the refi and return capital, that's well and good if that was the original business plan. So I'm not opposed to that. In fact, I do like that as an investor too. Obviously, every sale is great because you get all your money back, you take your chips off the table, but then as an LP, you're hit with reinvestment risk. Where can I put this money that you just took off the table versus, say, a refi where you give me some of my money back, but I'm still earning on that deal that's been off and running and I'm confident in. So I like both. If if you were told it was going to be a 3-year investment and they recap it 3 years in a marketed offering that they're retaining a GP, I personally can't argue with that. But that's kind of hitting all the check boxes that were all the expectations that were set on the front end versus, again, if you're telling me it's a 10-year deal and you recap in 2 years in a non-marketed offering, well, then I'm a little less happy. Does that kind of cover that for you, Sameep? Yeah. Yep, so, okay, perfect. Yeah. And like I said, it from my experience working on the sponsor side of a recap, that was the biggest question, is how broadly was this marketed? And as an LP, while I haven't lived through it in my passive deals, I couldn't argue with people's questions. I sympathize with them and understand where those questions are coming from, because I feel the same way. Am I getting the best deal as an LP versus you taking this out to market, assuming that it was going to sell one way or another?
Chad, you had a question?
Yeah. Hey, Evan. First off, thank you for joining the meeting tonight and sharing the information. Very much appreciated that you're touching on these subjects for everybody. So thank you for that.
You're welcome.
My question was going to be around a lot of the feedback we get on the forum and so forth is around, especially with the fund model, is with a single asset. At the very least, if I am investing in the single asset, you're probably closing pretty quickly. I'll start to see that return that much quicker because the deal's closed and we're moving into fixing up whatever the situation may be. With the fund model, we get a lot of questions around, well, gosh, they don't have any assets purchased yet, so I don't want to invest yet. But yet I know you as a GP, you want to have that money in so you can go start closing on those assets. Can you talk through, I guess, what your usual advice to LP investors are around that gap and how Ashcroft may make that up, or whatever the case is?
Yeah. So again, this is going to be very case by case. So while I'll speak specific to both the Ashcroft funds that I'm in, I'm in another fund that's using a capital commitment facility. So, in their case, they raise commitments, they take all those signed commitments to the bank and say, lend me 60% of these commitments. And then they raised $100 million. They have a $60 million acquisition vehicle, but they don't have to touch the equity for a long time. So kind of continuing down that train of thought, the downside to me is my $50,000, as noted, has to sit idle. The upside is when they call it, I'm already into a business plan. Like they own multiple assets that are kicking off revenue and off and running. With Ashcroft's model, where we do a commit and call, so you fund your investment in day one, it's thankfully, I'm going to put it quite bluntly, thankfully we have enough investors that trust us and want to get in, that they come in before that first deal closes. And in many ways, at that stage of our raise, with how we operate, that's the most similar to a one-off deal, because our fund 2, our current offering, opened in February, early February, I believe, was when we started taking commitments. We didn't close the first asset until April 19th. Now, when you look back at the one-off deals, so effectively that money was sitting idle from, February, let's say commit on February 2nd until April 19th. We personally at Ashcroft will pay that escrow, interest that the title company is paying us, which is 2% APR. It's not nothing, but it's a step above nothing. But it's something, it's more than zero. But when we did one-off deals, it was the same model. And again, this can be case by case with each sponsor, and I think most that do one-off deals mimic how Ashcroft did it, and the other couple that I've done, which is same idea. You get a deal under contract, you start taking your commitments. If it's a big sponsor or a good network of investors, they may fund that in a week. And so using that same timeline, you're still sitting on, you got to fund within that first week, and then you're still sitting on a 45 to 60 day close between due diligence and in normal times. Obviously you can push those up sometimes. And then from there, then you're off and running with the operations, and there's typically a delay before those distributions start. So as I view it, the kind of worst case in Ashcroft's structure mimics how most one-off deals work, in my experience. Now, the better case in Ashcroft's structure is how we have it structured. Once we own that first asset, that's the initial closing capital, all that money started. Anything that was funded prior to April 19th started April 19th, earning its coupon, starting to accrue its distributions. There's a slight delay of the partial month and then the full operating month. Then the month after that, first distributions start getting paid. So they're paid in arrears. we are in the cycle now in our fund 2 where the new capital is closed the first of each month. So anybody that's investing in August, regardless of acquisitions, starts September 1st. And from September 1st, their first distribution we paid towards the end of October, which is our typical distribution, towards the end of the following month, following that operating month. So September comes and goes, end of October, September's distribution's paid. So technically, you're actually seeing that first distribution in our structure faster than you would have in our one-off deals. But again, every sponsor is going to be different in how they operate. There are also those sponsors that I've heard of, I haven't personally invested with them, where they don't make any distributions for the first year on their one-off deals because their view is we will raise as little as humanly possible and then use operating cash flow to build up reserves over that first year before we start kicking in distributions. So again, it's just a trade-off one way or the other. And that comes back to these are questions you need to ask the sponsors because it is so variable, even in the one-off deals, and probably just as much, if not slightly more, in the fund model. How was it? BAM, I think, would only close new capital on their funds, and I haven't invested with BAM once they acquire a new asset. It's like there's kind of, you get exposure to the whole fund, but they don't officially start your money until the next deal is ready to close. So they never have more capital than they might actually need at any given time. Don't quote me on that. I think that's accurate. But again, it can vary from fund to fund.
That makes sense. I appreciate that. Is this Ashcroft strategy going forward probably with future funds as well?
For the foreseeable future, yes.
Yeah. Okay.
There's little tweaks we're contemplating for Fund 3, but in terms of the distribution, how the fundraise occurs with the first of the month, to start new capital, that has not currently been discussed. But at this stage, we're still very much in the let's finish up Funds 2 here by the end of this year, and then so more Q4 is when we'll start talking Fund 3 and those nuances a little more in detail. But Fund 1 or Fund 2 is identical in that sense to Fund 1. You raise the front end, hope you got enough capital to close that first deal, and then you're off and running and go from there. And I say hope, but officially we've always had that.
Makes sense. Thank you.
Mm-hmm.
Yeah, Evan, this always kind of comes up in our forums about the state K1s. Since if you're in a fund and you're in multiple states, what do you tell the investors about that? Should we something we have to worry about, and it's going to dig away at our returns?
Yes and no. Ask if the fund sponsor, and technically you should be asking this on single asset deals in income tax states, do you file a composite tax return for out-of-state LPs? So Ashcroft does in the years that capital, that there would be a taxable event. So I'm going to look back at Fund 1, which was last year's offering. We bought 8 assets, Texas, Georgia, and Florida. Texas and Florida are non-income tax states. Great, nice and simple, nothing to do. Georgia is an income tax state. So there was, as an LP in Fund 1, I got a single federal K1 and then a single Georgia K1. We own 4 assets, 2 assets, 3. I can't keep them straight anymore. We own more than one asset in Georgia, but they consolidate everything into that Georgia K1 from Georgia's operations. We happen to have a net pass-through loss, and Georgia's a state that does not require any filings if you don't have an actual taxable event. And so I got my K1 and, for lack of better terms, threw it in the trash, sent it to my accountant. He said, I don't have to file anything. I said, great, fine. But had we had a taxable event, Ashcroft would have filed a composite return into Georgia. And, the downside of a composite return is the LPs might be liable for a bigger tax bill than they would have filed or been required to pay had they filed directly. But what I have talked to many LPs about in this scenario, whether it be fund one or just broadly, is, something along the lines of, my accountant charges me $300 for every state I have to file in. And so even if I paid $150 instead of $130 for my, $50,000 investment in Georgia taxes, I still netted ahead a good chunk of change. I'm sure there's a threshold that once you get into a big enough dollar amount individually, it definitely makes more sense to file directly. And that is an option, at least that Ashcroft offers, where you're automatically part of a composite K1 or composite filing for any taxable states. And you can opt out if you don't want to participate in that. And then you get your K1, you have to file. If anything's owed, you have to pay, kind of scenario. But ask about the composite K1s, because that's what they're referred to, and ask if the sponsor does those on your behalf for that offering. And again, that's not unique to a fund. That would be any other one-off deal in Georgia or Ohio, California, anywhere you'd be investing. That's not one of those few non-income tax states.
Okay, thank you very much for that answer. Does anybody else have any questions or want to put it in the chat?
Just to add to that question, so Evan, are you saying that when you exit out of a property,
I don't think we can hear you.
Yeah, I heard when you exit out of a property, and I think I know that was going, but I'll let you finish.
Evan?
Yes.
So essentially what you're saying is, just to piggyback on that question, is when you are exiting out of that property, when you sell that property, that's when that taxable event would happen, right?
Most commonly, yes.
Okay.
My compliance officer would kick my butt for many reasons right now, but I'll trust that you guys are all, nobody's going to report me to it. But Ashcroft has historically not shown any taxable gains on their K1s until we get to exit year. And I think that's pretty common for most value add, 3 to 5 year hold type companies. However, technically, if there was a net income, a positive box 2 income, then there would still be a filing required, even if there was no sale. But most commonly, yes, the composite K1 most commonly comes in with the sale year when there's an actual gain. And again, at least how Ashcroft, I think this is consistent for anybody that does composite returns, is the sponsor files on all the out-of-state LPs' behalf and pays. So like you, for all intents and purposes, don't have to do anything. You will, in most cases, those sponsors aren't just paying your tax bill for you out of the goodness of their heart. It's deducted from your final distributions, but ultimately you would then not owe anything. You wouldn't have to mail a check. You wouldn't have to file anything in those states.
Okay, thank you.
Anybody else have any questions? We're getting to the top of the hour here, which is usually when we end. Anybody? All right, so I'd just like to thank Evan again for taking his time to explain the differences between funds and single asset deals. Evan, can you give us some information about how they can reach you?
I can. In fact, that was actually my last slide, but I'm not sure. Would it be easiest, Steve, if I email you all my contact information and you can just kind of circulate to the group?
Yep.
Okay. I can put in the chat here or whatever,
okay.
but I know sometimes the chat just disappears as soon as most people close this.
Right. Yeah,
something.
either way. Yeah, we can put it in the recap video when we send out the email.
Okay.
Yep.
Yeah. I'll send that over to you, because I will include, I only have one cell phone number, which is technically already in the signature line that we've been trading on. But I'll include my personal email as well, because officially, from a compliance purpose, some of this stuff that I'm talking about most of it's really, personal information I'm happy to share with your group. but I will include my Ashcroft email just in case somebody wanted to reach out directly on a more professional Ashcroft specific type level of questions. And of course, I'll forward back and forth to get them in the right channel should I need to. But yeah, I'll share all that information with you here post this call so that you can circulate that with the group.
Okay. And as usual, we'll have the post-meeting networking if you guys want to do virtual networking on the wonder.me platform website. The password is LFI22. And just make sure you close your Zoom window. Otherwise, I think you can get some echoing in the other platform. But when you get in there, make sure you kind of move around. Or I think if you're on a phone, you just click on the group that you want to be with. But there's multiple interests, if you will, that you can go to and just kind of hang around and then either join a circle or make your own circle or and then just start talking, because then you can actually enter and exit other conversations. So hopefully we'll see you on the other side. And Evan, you're more than welcome to join us as well.
Thank you very much. I will definitely stop in for a little while.
All right. So I'm going to stop the recording and I'm going to keep this on so that people can get the link. And again, look out for the email about more information about the meetup in the left field coming up in October 21st. All right, we'll see you guys later.